Hi, everyone. Welcome.
G'day, Cameron.
Christmas edition.
Christmas edition.
Morning. Good morning.
Feeling a little bit Grinch-like without the Christmas hat on, though, I must say. It would be nice to have the Santa hat on.
That was Cam's job, wasn't it, to bring those in? Someone said before.
Yeah. Let's get into those later. Looking forward to the Christmas party later.
Yep.
Yeah, it should be good.
Should be fun. Great to get the team together. Yeah, should be fun. All right, everyone. This is our last edition this year. I guess what we're keen to talk through is how markets have been going over the course of the last month or so. Give a little bit of a wrap up in terms of what we've seen this year, this calendar year, sorry. And then subsequently a few other topics that we want to run through, and then wish everyone a Merry Christmas. So I will just share my screen so we can see the economic update, and we'll also get a full size. There we go. How's that for you guys?
Good on this end.
All good.
Great, thanks, Cam.
All right, GDP growth. This is GDP growth number around the world. Again, pretty consistent with last month, guys. We've had clearly a drop off post what was some very significantly high numbers around the world post COVID or coming out of COVID, and we've seen GDP growth drop around the world, still sitting a tick under 5%, which is reasonable. It's around about 4.3, I think. Yeah, go ahead.
I was going to say, Cam, you know what I find fascinating, to your point before about end of the year, reflecting on the year that has been. When you look at that chart and you sort of stop and pause for a moment, the last couple of years have been crazy, really. I mean, that dip down through the start of COVID, the bounce back, and then the pullback. Like I think in time, we're going to look back at these numbers and really kind of think, my goodness, this has been a roller coaster of GDP for the last couple of years. But I think notably there, that's where the trend line starting to get towards is kind of a bit closer to that sort of longer term average trend line, which if somehow the central banks can maintain a level of GDP growth that with a raising rate cycle, I think it'd be quite remarkable. But yeah, I just want to make that point, sort of reflecting on the enormity of those movements over the last couple of years.
I think you're right, Shane. Well, if you look at the other major piece in there, right, that's the GFC.
Yeah.
What's the time frame on that? That's what, 30 years, is it, Ken?
This is back to early 2000s.
Yeah, right. So,
Yep.
yeah. So to Shane's point, right, it's going to be the significant global events, and then otherwise we're kind of back around bubbling within that sort of normal range, which hopefully we're back somewhere close to that.
Exactly.
I guess what we don't know clearly at this stage is roll forward 12 months, 2 years, and then looking back retrospectively, what would we have seen? So that's obviously the great unknown, and that'll start to play out with all the interest rate increases we've had over the course of this calendar year, and what sort of impact that has on the global growth rates going forward.
GDP growth going forward. That's right, Andrew.
Yeah.
In terms of GDP growth in Australia, we're looking at a fairly similar number, right? So it's reflective, and to your comments before, Shane and Chris and Andrew, there was a very significant reduction due to COVID. I mean, essentially the economy slows down, so it could have been worse. But yeah, we have seen a bit of a recovery. Significantly, this is CPI numbers in Australia, right? So those CPI numbers in Australia are up around about getting close to high sixes. And so when you've got GDP growth in Australia at 4 and you've got inflation at 6 or 6 and a bit, that's not sustainable longer term, is it, guys? So which is why we're starting to see the Reserve Bank over the course of these last 12 months increasing interest rates really significantly.
Yeah, I think it speaks again to that sort of the serious anomalies in the world that we've lived through, and I really do hope and aspire that we see these things normalize, because I'd think probably safe to say from my perspective and all of our thoughts, not just us from an economic point of view, but everyone as investors as well, feels a little bit uneasy when you see these big outliers in data. And, you know, I certainly sit a bit uneasy with inflation and the like at this point in time, and the sort of subsequent unknown, to your point, Andrew, about what the interest rate rising cycle actually looks like in 2023 and the impact on this data.
Yeah. Trying to change the slide here, guys. There we go. And then again, I suppose inflation around the world, you know, fairly consistently high. Certainly in the euro area, which includes the UK, you're looking at high nines. The US is about sixes. Japan, interestingly enough, Japan's never been able to get an inflation rate above 2% for a long time, and they're now saying hit 3%. So, you know, it's not just a problem that's just in Australia; it is around the world, which is again why we're seeing all the Federal Reserve in the US and ECB and the Reserve Bank of Australia are increasing interest rates to try and curb inflation. So that's likely to continue for the time being. But how long is, I suppose, the point of the question. I
was just on that part about Japan. You know, interestingly enough, the market got a little bit spooked the other night with some of Japan's comments. Exactly to your slide there, Cam, is that they're now starting to join the party of all the rest of the central banks around the world, and there's a bit of interesting economic situation in Japan for a long period of time. So, yeah, they're not immune from it, and maybe it might be a good thing for them in time if they can actually kind of create some inflation and create a higher interest rate environment in their
that's
economy.
right. The biggest issue in Japan has been their demographics, right? So the significantly aging population, lower birth rates has meant that as people get older, they're spending less, and subsequently we haven't seen really any GDP growth, or with an extraordinary amount of both fiscal and monetary policy being pushed to the Japanese people. So, yeah. Okay, wages and unemployment. Who wants to talk through this one?
Oh, I'm happy to start on it, and I think it's probably, for those who watched last month, it's probably not too dissimilar in that the market is just so tight right now. Right? You know, wages are trending up, unemployment trending down, and the anecdotally the businesses around the country are really battling with finding people to work for them. So yeah, it's I think it's a genuine pressure right now, this position. But you know, I'm always half glass full when it comes to wages growth, and I know there's a sort of economic theory that suggests sometimes it's not great, but I think you know, you can't begrudge anyone having a higher, you know, income, and importantly now, wages growth is still growing at a lower rate than what inflation is. So, you know, whilst it's going up, it's still growing at a lower rate. So, you know, it's still not really helping with the real cost of living for those who are, you know, kind of earning at this point in time.
Yep.
Just as an aside, sort of, but related to the participation rate, I think we were having the conversation yesterday, Cam and Shane, but there was a stat out yesterday to say that the labour employment participation rate in the 55 and over category, there's been quite a dramatic growth in that over the last 20 years. So going back to the start of the century, it was just around 11% of the workforce was in that age group, and now it's up around 20%. So almost a 1 in 10 proposition to a 1 in 5. So it's been, which I guess points to, you know, what's been known for quite a while, an ageing demographic, but also, yeah, in more recent times, the fact that employment is quite strong, and it's allowed potentially older people that would otherwise have stopped work or have returned to work, because there's an opportunity for them to continue to get an earn. Which has been an interesting sort of little byplay our last couple of days.
Yeah, no, it is fascinating. I think more people have an opportunity to work later on in their life, the better, right? I think certainly a lot of, well, very wise and a lot to give. So it is interesting how that demographic changes, though, isn't it? Yeah, and look, just on this one, employment participation rates obviously at an all-time high, which is what we're looking at here. Employment to working age population at an all-time high. And then also the underemployment rate is really rocketed down. So it's probably a good space to be in, and everyone's employed. It just means that the labour market gets really tight, and then the potential is that as we see wage prices pushing up to combat CPI. That becomes what's called demand pull inflation, which is not what we have at the moment. And that can be harder to slow down. Okay. House prices, household debt, and net worth. Chris, do you want to talk us through this, mate?
Yeah, look, I think we're starting to see some, I guess, the tops come off. I guess what we were talking about last month in terms of that, and as you can see, if I start top left, house prices are falling. I guess that's a pretty barbecue kitchen table topic conversation. People are probably already reasonably aware of this. So in terms of what that feeds into, if you flip over to the right, at top right hand column where you're looking at the net wealth number peeling off too. As we talked about this last time about the wealth effect from an economic standpoint, it's what we should start to see is some of that play through into, I guess, if we're coming back into the earlier slides around GDP and behaviorally what that means for people. I think given both have climbed fairly strongly over the last, let's say 12 to 18 months, we were probably expected to have a bit of a cool off or a pause, because as we all know, you can't have infinitely exponential prices on assets, because all that does is create instability. So not necessarily a bad thing, but just more that's kind of the state of play at the minute. And then as we talked about, we'll see what happens moving forward in the coming 12 months with interest rates and what effect that has, because we've talked about again over the last few months about debt positioning and how that relates to house prices. Obviously, where the more people can borrow, the greater house prices go up. So from my perspective, I don't know if you guys have a different perspective. I'm sort of looking at that going, all right, this is a bit of a normalization, which I'm kind of okay with, as long as next year we get some stability.
Yeah. I think interestingly there, this is house prices and household debt, disposable income. And this little dip here is what we saw when they dropped, the Reserve Bank dropped interest rates down to home loan rates down to essentially just a bit below 2%. Now that has actually made its way back up to where it was now. So debt to income, the cost of having debt for most Australians has increased back to where it was prior to the pandemic. The other thing here that is housing loan commitments have fallen, which is what you'd expect. So essentially the price to buy a home has increased significantly. Back in December, $1 million mortgage is costing you $20,000 a year in interest, and now it's costing you $50,000 a year in interest. Yep. So that $30,000 in that one instance has come out of the economy, is being paid as interest to the bank. So that's how the Reserve Bank is slowing the economy down, and it's working.
Good for those holding bank stocks.
Sorry.
Good for those that are holding bank stocks.
Yeah, their cost of capital has gone up too, though, right?
Correct.
All right. On markets, want to talk through this?
Yeah, I'll talk to that, Cam. It's I think this has been the biggest stressor of the year, and I think this is the story of 2022 for mine.
I agree. Yeah.
Bonds. It's counterproductive or counterintuitive in a way, because we hear the headlines in the news about volatility in the stock market and stresses around the world, and this doesn't really catch the headline, but it's certainly a third time in 100 years this has happened, and never to this magnitude. So I think this will be a period of time that we don't reflect on fondly from a bond perspective. But pleasantly we're starting to see some kind of pick up in return, and there's still a ways to go, of course. And this is again on the back of what was a pretty good month before prior. So now it's a couple of months of good bond returns. And I think really what this speaks to me is it's going to take a little bit of time and a bit of patience to kind of see bond valuations fully recover. But pleasingly in the short term, those bondholders that are patient with their bonds are actually getting rewarded higher now with a greater yield, both but it is a capital, capital dilemma right now in terms of the return that we've seen from bond markets.
And just on that, and what I find with some of my clients and other people that I chat to is that people don't really understand. Yes, we've seen significant volatility in the valuations of bonds, but let's say, and you guys talk me through this. Let's say that I bought a bond a year ago, and I bought it from the Australian government, and it had a 5-year term. And so subsequently, at that time, the Australian government is paying me, 0.8% each year as interest to hold the bond. Now, there's 4 years to go left on the bond term, but the value of my bond now is probably worth, instead of being worth $1, if I wanted to sell it on the secondary market, I'm probably getting, well, according to this, I'm getting 90 cents, right? What happens in 4 years' time, Shane?
Yeah, I think we'll see them mature back to their dollar par value, which is, the pleasing part about this journey. And I think the duration of bonds and kind of managing that duration in portfolios, which you're seeing today, and a very active focus on it right now is so critical to make sure that we can allow people to hold them to maturity to kind of recoup their capital. And that's why I think it's sort of a harder road or a difficult, thing to wrap your head around, because I feel okay about the bond market because they will stabilize and they will come back. But the short-termism of it is difficult to deal with emotionally. But, I think broadly speaking, when we hold good quality bonds, they're guaranteed to kind of come back to their issue price. And I think we sit okay on the longer term picture with these assets.
Yeah. I think that's a really important last point, Shane. While you're talking, all I was thinking is it's about your perspective about how you're looking at it. So, if you're looking at it in a narrow tunnel of, say, the last 12 months, you're looking at it going, what the hell's going on? This is terrible. But the whole rationale for how we set these portfolios up and how we design them is for longer time periods. And I think it's important that everyone understands that we look at it through the wider lens, not through the narrow lens. And that, to Cam and Shane's point, like those, by their pure structure, as long as the governments that back them don't become insolvent, we'll get our capital back plus our 0.8% income return that we bought them at, if that was what we bought them at. Just important that people understand that this the perspective that you look at it through impacts, to your point, Shane, how you feel and your emotional response to it. So just to bear that in mind for those who are feeling a bit uncomfortable at this specific juncture.
Long term. And I suppose that's a good segue into equity market performance too, right? So the Nasdaq's down 28% this year, essentially. S&P 500 US equity market down 15, Europe's down 11, Australia's only down 4. That's more a function of timing. So we've seen negative performance this year. It's been a pretty crappy year, although in the last probably 6 weeks, and then again today, markets are up. So we're starting to see that reverse, aren't we? Through here, up 1.5% today.
Yeah, we'll probably capture a little bit in the slide here, Cam, to your point there, that pretty strong numbers here for the last month or so. Yeah. And which is, again, when I look at these numbers, of course, we always like seeing green and positive return, but I smile about these numbers because I think it does really reward those that are patient with their portfolios. And, I think every investor intuitively thinks about longer term investing, but we can't help not get caught in the short-termism of noise and fear. And I think it's so nice to see when markets start to give us something back that we kind of feel a little bit more comfortable about the strategy that we're working with. So, of course, we all hope these keep rolling through to next year. And, as to your point, Cam, we've had a strong couple of days again, which has been nice.
Exactly. All right. So this is, I think we've come to the end of what we wanted to chat about formally. This is obviously only general advice. For specific advice, come and see your advisor. So you shouldn't be making investment decisions based off what you've just heard or watched. Okay. Is there anything else we want to chat through on that front, guys?
No, I think we're all just hoping for a good 2023 return-wise. Assets are coming back and life feeling somewhat normal again, which would be,
Might be more positive
know,
after the conversation.
yeah. I was thinking about this the other day and thinking, well, end of last year, this time last year, we all kind of felt, we've got through the pandemic and we're kind of, the worst is behind us. We roll into this year and it was kind of a pretty rough year market-wise. So hopefully 2023 is our return to normal.
A reminder. Yeah.
Be interesting. I was just thinking maybe it's just something we should do for the January update. But if history is a guide, as the big negatives are typically followed by some fairly nice positive years to bring up that historical Is it the Morningstar chart? That's like the coloured grid that goes through each of the asset classes.
Yes, that's right. Yeah. This slide speaks to it too, man.
Yeah. So
the bull years are much longer than the bear years.
Yeah, correct.
Let's hope for some bull years. Yeah.
No guarantees, but let's hope history continues repeating itself, because we all forget about the lessons we learned previously.
We do.
And as Shane touched on before, and as we always say, it's just ride out that short term, because history will show you it happens all the time. Things go up and down, but it's a long term trend, and just being patient and not panicking is the aim of the game.
Diversified portfolios help. All right. Christmas message.
Everyone,
have a great Christmas, everyone.
Stay safe.
What are you guys doing with your Christmas break?
Oh, I'll kick us off. I'm looking forward to spending some time with the family for a week or so down the beach, and that will be very nice.
Yeah.
And I think we've through the pandemic and years have gone in the last couple, that I think the importance of spending time with friends and families is more relevant than ever, and I continue to be very grateful and appreciative for those moments nowadays. So that's what I'll be doing, Cam. Looking forward to it.
Very good.
Well, after going to the Boxing Day test on Monday, which hopefully will be COVID-free this time around, on the Tuesday, heading off to Port Douglas for a week with the family as a end of school celebration. Youngest just finishing Year 12, and eldest went through Year 12 in 2020 when COVID hit. So we didn't get a chance to sort of celebrate his end of school. So yeah, looking forward to that, spending time with the family, which will be very nice. Nice reflective piece too, I think.
Yeah, that'll be amazing.
Yeah,
fantastic. Yeah, it'll be great. So beach, Chris?
Yep.
I am, for the first time, and I think in 5 years, doing absolutely nothing, which I cannot wait. For those of you who know my family situation, my other half is from Sydney. So we've spent the last, due to COVID, we've spent the last few years in Sydney where we can, because we just haven't been able to see extended family. But Naomi's off to a wedding, so I've got the kids, and I plan to sit watching a lot of cricket, and hopefully the weather's nice, sitting outside under a tree doing nothing, which I'm pumped about. So
that's the epitome of like that break, isn't it? Like for me anyway. So that break between Christmas, New Year, the Boxing Day test is on, and then in case you don't get enough Boxing Day test and cricket during the day, you get the BBL at night. It's like how good's cricket?
Yeah.
For me, the Premier League starts after the cricket finishes, so just watch all the way through.
It just continues. Family at home. So we're hosting Christmas this year. It's our turn, so we're just having everyone to our place, which would be great. I think we're staying for a couple of days, and then be similar to you guys, watching a bit of cricket. Might go to the Boxing Day test. I think that would be take the kids along. All three of them these days they love cricket, so therefore my wife doesn't have a choice. I like it. Blaze, hello, how you going? So no, look, should be a really good break. And then of course we're officially closed until and we return on the 9th of Jan. I know personally I'll be in and out a little bit. There's again more cricket to be played by my eldest son during January, so I'll be around, but not available. And what about you guys? What are you back?
Yeah, much the same, really.
Yeah.
Be back on the 9th. I'll be around. I don't think I'll necessarily be in the office, but we're doing a staff day on the 16th of January. We're all heading off to the Australian Open for the day. So for those who are listening, I guess you can block out the 16th because no one will be around. But otherwise, we should be here to be contactable.
Yeah, that's right. Okie doke. Merry Christmas, everyone. Happy New Year. It's been great working with all of you during the course of 2022, and we're really looking forward to catching up again in 2023. So thanks very much, and we'll chat to you next year.
Have a safe break, everyone.
All the best, everyone.
Bye for now. Keep well.
Bye.